So today I have with me Mr. Venkatesh Sanjeevi, who is the Senior Vice President and Portfolio Manager at Franklin Templeton. He has been in the investment management industry since 2007. Prior to joining Franklin Templeton in 2021, he is the Portfolio Manager of the Franklin India Large Cap Fund and the Large and Mid Cap Fund. He is also the co-fund manager of Franklin India Technology Fund. He has worked with large global and Indian fund houses. Thank you so much for coming in, sir.
My pleasure. Thank you for having me here.
And we've had multiple conversations before this formal podcast that we are having. So let's start off with your investing philosophy, how your journey has been, what your history has been.
Sure. So if I go back in time, basically I joined this industry in terms of the formal working industry in something around 2007. Although a few years before that I was sort of investing in stocks on a personal level, but formally I joined industry in 2007. And I was very lucky because 2007 to 2010, the period of 2-3 years, the amount of things you saw was probably something you would see over 8 or 10 years. Because 2007 was the towards the end of the crazy bull market of those time, and there was Sensex would go up like 1,000 points every 2 weeks. There would be celebrations everywhere. I was based in Bombay then, and you could see the exuberance in general. Every day there would be a mail from from our HR saying welcoming some 40 people into the office, 50 people in the office. Every day 40-50 people would join the company. The company was desperate to look for more and more office spaces. We were in Nariman Point then, and office space was limited, so there used to be a urgency to find extra space to accommodate all these people. So it was the heydays of that bull market. And 2008, exactly the opposite. Things started going down, markets crashed. There was hiring the previous year, there was a firing next year, and the way markets fell, stocks, headline markets were down maybe 30-40% or so, or maybe even more, but so many stocks were down 80%, 90%, and then people would think that the stock was fallen 80%, it can't fall more than that, they would go buy it, and even then it will fall another 30-40% from there. So it was just an incredible period when markets was just completely going haywire. And then of course 2009 and 10 the recovery started, but that period was an amazing experience because you saw the exuberance of bull market, the massive destruction of wealth of a bear market, and then slowly things coming back. This is on the market side, but also important what happened behind it. How did the US Fed sort of act in this period? What led to this market crash? How did Indian government act? So there was a lot of things which you learned in that period, which I don't think we have seen it subsequently at this magnitude. COVID was a crash, of course, but it quickly recovered after that. But we haven't seen what we saw in that period. So I was lucky to have entered the market just before all this happened and lived through all that.
Well, what do you do when something falls 80%?
Pray. No, really, you can't do much. See, basically, you can't react after that thing happens. What you need to do is have a thesis beforehand and have scenarios in mind and keep testing those scenarios, right? You keep testing those scenarios. And if the fall is justified in terms of fundamentals really deteriorating, then you do nothing. But sometimes a fall could be extra. It's like a pendulum, right? Sometimes markets swing towards one extreme. And if your thesis of a particular company or a sector remains same and the stock has fallen a bit too much, then you act on it. And you have to keep on have a view and keep testing that view.
And how did that shape into that investing philosophy that you use at Franklin? I remember when we were sitting together, you wrote it down, and you were articulating it very well. So how did that shape up into a very strong investing philosophy?
No, I think over time each of us experience the markets, and then you have set of people you work with, you learn from them, and then over time you've sort of build your own approach to managing funds. I think what I'd articulated to you was the difference between price and value. I think that was the conversation which we had. And just to explain that a bit further, I think these two terms, price and value, are used very interchangeably in the market. A lot of people use it in a very similar way, but actually these two are very different, right? Value is, what a company is really worth. This is based on a lot of analysis of the company, of the management, of the industry, some estimates of the future. It's a bit of art and a bit of science. So you ask 10 people how much is a value for a company, you'll get 10 different answers. So you can't have one number for all of this. And that is where all our effort goes into, to research a company, to understand the company and find out what's the intrinsic value. And that's where we can really make a difference. Price is what the market throws at you, right? You go to the exchanges, you see a price. You can't control the price. Prices, this is what is available in the exchange right now. And prices tend to be a lot more volatile than value. Of course, value does change based on events. Some new developments may happen and the value of the business changes. But it's not as volatile as how the price moves up and down. I think what our effort should be, or what we try to focus, is what's the intrinsic value of a company. And then you see the price which market offers. And whenever there are, and it does happen very often, there'll be big disconnect between what's the true value of a company and what's the price which is trading at. So if the true value of a company is 100 and it's trading at 80, you go and act in the portfolio accordingly. And vice versa. If the true value of a company is much less than today's market price, then you take the actions. So I think my effort, or the philosophy, is to have a lot of focus on what's the intrinsic value of the company.
And then in this day and age, there's so much of information available everywhere. And it's a lot, actually. There's so much. You get to Twitter, you get, company reports, and, there's so much of quarterly reports that come out. With so much of information available, how do you ascertain that value to say, yeah, you know what, this is the price that I'm willing to pay. And because of all this information that's there outside, it's trading at this. So how do you connect, or how do you see the disconnect between the two?
Yeah, I think it is a combination of many things. One is, of course, experience. Having been in the market for a while, you kind of understand what to focus on and what not to focus on, how to use your time better. I think these things you would learn over time. Secondly, the team, if you have more people with the same sort of approach, it really helps, which is where Franklin comes in with that similar philosophy across the team. In a bit of a especially kind of work we do, and when you spoke about a lot of noise which is happening, I think being in Chennai is actually a blessing for the kind of work we do, because I've lived in Bombay. I've also lived in London. A lot of being closer to action, sometimes you get overdose of all this noise, or a lot of things which are not aligned to what you look for, more short-term oriented kind of these things. So that way you're being away from too much of noise, and also some softer aspects like the commute and amount of time you spend on non-productive things. All that is probably easier in a place like Chennai. And I think even globally, if you see, you take UK, while there are a lot of funds in London, there are a few funds which are based outside London as well. Similarly, in the US, while New York has got a lot of funds, there are quite a few successful funds which are based in other cities. So I think also being a bit away from, it's important to be connected, but you don't have to be, for the kind of work which we are doing, we don't have to be in the noise as such. So I think that also helps. So I think it's a combination of all this, figuring out what is relevant, what is not relevant, and focusing. All of us have just 24 hours a day, which we need to make the best of. And so I think you will learn all that by a combination of all this.
You've seen multiple cycles. You've gone through it. Like you said, 2008. My generation doesn't know 2008 at all. We've just read whatever's been told to us, or whatever we've seen in videos. But you have first-hand experience not only with that cycle, but multiple cycles as well. So what have been some of those early learnings that say, okay, going by that, if I have to go by such events that took place, today if I have to make a rational decision, those learnings have helped me make that rational decision. Do you think that some of those learnings have been there here?
Definitely. I think there are multiple learnings, and not just from 07, 08, that cycle which you spoke about. And every cycle you learn new things. COVID period taught us new things. In fact, if you were too negative post-COVID, having the 08 experience, you are probably caught off guard, because the rebound was very quick. So every cycle, every period of the market teaches you new things. And I think in our job, it is not possible to get every decision right. Our job is to take some calls based on a future view of the future, which by definition is unpredictable. So it's impossible to get every decision right. So we do make mistakes in the portfolios. We do make mistakes in multiple things. But for me, making mistake is part of the process. But what is important is not to make the same mistake a second time. I think we should introspect a lot after something has not worked out and see why this has not worked out, reflect on it, and reincorporate this in your philosophy or an approach to make it more robust. You may have a certain view, but with the new data coming in, reinforce it and make it more robust. So I don't think I'm trying to, or anybody can make a portfolio which is immune to mistakes, but what we can do is not repeat the mistakes. I think that is the basic approach.
But I think you made a very important point, because what retail investors think is that, yeah, I'm giving money to a fund manager, no, I'll get 12% return no matter what happens in the year. Right? But that doesn't happen. It's not reality. And this is a very, very important point that you made, that, mistakes will get made even at the highest level. We will continue to make mistakes, but you learn out of mistakes.
Yeah.
Any mistakes that you can tell without naming any mistakes that you said, this was bad, and going forward, that mistake never repeated back again. At the same time, philosophy became a lot more stronger.
Plenty. I mean, I think it's important we make mistakes, but obviously not to have and learn from the mistakes. But obviously, the mistake shouldn't be so big that derails the entire portfolio. So that's why risk management and sizing the portfolio is very important. So as a portfolio manager, mistakes can be in plenty, right? Mistakes can be in the stocks you choose to buy. Mistakes can be in the stocks you choose not to buy. That also can be a mistake. And on selling, again, it could be a selling at the wrong time, or maybe selling too early could also be a mistake. If the stock is still on the journey of
but this well. Everybody thinks, if I sell early, nobody knows if they are selling early or not.
Absolutely. You'll never know when it's happening. But again, that comes back to what I said, that, you have to keep reviewing a decision, reflect on it, and see whether you made the right choice or not. And if something is at a philosophy level wrong, you'll always make things which don't work out. But at the philosophy level, the reason why you took the decision, if that was wrong, make a modification to this philosophy. One of the things which I had reflected was there's one company in my portfolio which was a new company in the sector. It didn't have a very long history of trading because it was a recent IPO, and then there were huge amount of different views on the stock. So the stock was very volatile. While I did have a fairly positive view on it, in hindsight, at the bad time, I don't think I had an adequate position size on it when the stock was volatile. So I did reflect on it, and subsequently, a couple of years later, that stock again gave an opportunity, and then I kind of rectified my previous mistake by making sure, if you have a fair amount of conviction, make sure the amount of investment in that stock is commensurate to that. So for a portfolio manager, even that is a very big thing. Not just the not just whether you're going right or wrong, but how much you make when you go right. I think that's pretty important as well.
And you said that, when you made that particular mistake of not having adequate data, or seeing that, okay, I need to wait. How long did you wait for that point of entry to come to you? Because what people think is, and you said that underlying philosophy needs to be there. But what people think is, it's gone up 20% from your, I made a mistake. Oh no, something has changed. And people get that bias that, okay, price went up, so I made that mistake. But the underlying philosophy.
Correct.
Second, what you said, how long were you being patient for that point of entry back to come to you?
So you sometimes you are waiting forever. It doesn't always happen, right? But the thing is, when it happens, you have to act on it. What is okay is that you have a view, and you have a certain price in mind based on your view, and the stock doesn't come to the price. It's fine. But what is not okay is that you have a view and the stock comes to a price and still you do nothing because of whatever short-term reactions or this thing. That is not okay. So there is no time frame saying I'll wait for so long. I think that shouldn't be a parameter. What should be a parameter is whether your view has played out or not. Like I said, stock price movement we have very little control over. Something happens in the US, stocks here will move up and down. But that doesn't mean that the fundamental business has changed so much.
So is it easy being a contrarian?
No, I think nothing is easy in this line, but you get, over time you kind of learn how to handle it. And I don't think contrarian, I think contrarian is more the outcome of the philosophy. It's not like intention is to be contrarian. The intention is to buy good companies at below intrinsic value or fair value. And so typically what happens is you get those opportunities when that particular company or the sector is not doing well. To give an example, IT was not doing well, let's say a few months ago. At that point of time, it was probably going below intrinsic value. And if you buy it at that point of time, it looks like it's being contrarian. It is being contrarian because the stocks have not done well. But the action is taken because the stocks are now at a fair value. Similarly, on the opposite side, you tend to sell something which has done very well because the stock has gone way ahead of the intrinsic value. Again, it sounds contrarian when you actually execute it, but going back to it, it's basically the philosophy of, if something is way beyond fair value or intrinsic value, you don't make too much return from there on. So it is obviously difficult when you're doing it, but I think once, just like everything else in life, you do it sufficient number of times, you get the confidence, and then even the market understands what we are trying to do in this particular product, in a particular portfolio, then it becomes more as a routine rather than anything else.
And you said that, it's a little difficult as well, right? Because you have to hold your nerve sometimes. So you have that experience of holding those nerves, but then somebody who's coming in new and he says, I want to follow this sort of philosophy of being a contrarian. I don't want to do what the market is actually telling me to do. Right? How should they manage their emotional biases?
No, so first question I would ask is, this is not the only style in the market. There are so many different styles. I think everybody should choose the style which they are comfortable doing it. Right? There are a lot of people who play momentum, who like to buy stocks which are in momentum. Some people who are very value conscious, buy stocks below a certain price to earning multiple. I think it's important that each person understands the different philosophies, different ways of managing money, and then choose the one which they resonate most to. I think once you get that right, then everything else comes along with it will be much, much easier. You make a person who's a high growth investor to kind of buy deep value stocks, it's not going to work out too well. So my answer to the question is, before you get in the process where any young person coming in, figure out what connects with you, figure out what you feel like doing, have that framework, and then try to implement that subsequently.
Today the connect is high growth and momentum. And speaking of high growth, everybody is running behind mid and small caps.
Yeah.
And being a large cap fund manager, how do you see retail viewing large caps? Because they feel that it's easy, large cap mein kya return? I'll easy for me to make 10-12% return. But from your lens, how do you see, managing large caps?
No, I think today it is probably, not the peak of this particular issue. I think 2023, I had a very tough time at that point because large caps were giving decent return, but mid and small caps are giving extraordinary return, like 30%, 40% sort of compounding. I think last 1 year, 1.5 years, I think that tide has kind of turned a bit. I was just looking earlier today that I think it's almost a 10-15% gap in the index performance of large cap versus small cap in the last 1 year. I think even on 2 year basis, now large cap is ahead of small cap. But we have seen the cycles. I mean, small cap, let's going back to 2013-14, they were all trading at extremely cheap valuations, and markets were not really rewarding that. So that bounced back subsequently in 15-16 thereabouts. And so each class has got its own cycle, and we need to know where we are in that cycle. So large cap was in a relatively weaker cycle 2 years ago, and that is slowly changing. I think there's still some more catch up to be done. I think last 1 year we have seen the massive gap in performance, but even now on a 3 or 5 year basis, small caps are outperforming, which should probably narrow at some point of time. And going ahead, this cycle will keep playing up and down. At some point, small caps may become very attractive, and then people will be chasing large caps. And the same question which you asked me would probably become reverse. So I think as investors and as managers, we should be aware where we are in cycle and expect what the product is supposed to give. Right? I mean, I had a tough time in 2023 or 2024 explaining people that large caps are not meant to give 35-40% per year return. They are meant to be more stable, steady, compounding companies. If things go really wrong wherever, large caps would not fall as bad as what small caps and mid caps may fall. At the same time, when things go well in the economy, when there is a sort of a beta playing on the market, small caps obviously will do better. Don't expect a small cap sort of a return at the large cap sort of volatility. That combination is not going to happen. You will have less volatility and less return in the large cap category. People will realize it over experience. I think a lot of people have entered the market post-COVID who have not seen all these cycles in the past. I was just talking to a friend of mine, and he was saying his portfolio is extremely bleeding right now. But you look at markets are at all-time high. And most of these people have entered the market in the last 3 or 4 years expecting a 25% return every year. So they would have become wiser now with this cycle, and over time a new set of investors will come in and the same cycle will again go on.
I like how you said wiser when you're losing money.
It's the tuition fee you pay to the market.
But now we are in that cycle where large caps are becoming a lot more, have been very attractive. They're doing extremely well.
Yeah.
How do you change your hat? Because you're managing multiple strategies and large cap makes you feel very constrained because you have only 50 names that you can pick and choose from because of the benchmark. So how do you change your hat to say, okay, now I will change my hat to become a lot more aggressive when valuations are for me in favor, and I'll try to hit a 6 when I'm managing the other strategy?
No. So there is no separate hats we wear. I think it's just the same, this thing. Although I manage 2 funds with different mandates. One fund is a pure large cap mandate where 80% of the money has to be in the top 100 stocks by market cap. The second fund is a large and mid mandate where at least 35 should be in the top 100 and at least 35 should be in the next 150, the mid cap segment. And the balance 30 can be anywhere. So the philosophy is exactly the same between both the funds. It doesn't mean that I look for a philosophy for the first fund and a very different philosophy for both funds. The philosophy is same, except obviously the mandates are different. So there could be a large overlap in the stocks, but the weightage could be very different based on the mandate. For the mid cap fund, the weightage for a mid cap stock would be more versus the same stock in a large cap fund. So there is no different hats which we need to wear. The same philosophy for both the funds. So you had one sub question in your thing. Large cap has 100 stocks to play with, but it is still very much possible to create alpha. I think a lot of people have a misconception that you just have 100 stocks of universe. It's difficult to.
We'll do ETF.
We'll do ETF, I think. But there is massive. I mean, this is a place where research actually comes into play. Large cap category. It is a very challenging category because of the constraints you mentioned, 100 stocks plus passive and all that. But if you do good research, if you do good portfolio construction, there is massive alpha to be made. I mean, you take any sectors. I mean, even sector like staples. I'm just giving an example. In the last 1 year, the best performing stock in the staples universe in the large cap space was up 25%, while the worst one was down 23%. So almost a 50% gap in 1 year within the same large cap sector. This is true across, you take automobiles, large automobile names. The worst stock is down 25%, while the best is up 50% in the last 1 year. So almost 75% gap in performance within 2 stocks in the same sector in the universe. That's true for financial services. So you choose the portfolio construction in terms of the stocks and have the adequate weightage. It is definitely possible to create good alpha in the large cap segment also. And then we also have the 20% leeway, which can be anywhere. So in the past, I have taken positions in mid cap side, some small cap position, also some international stocks. Today, I do have some Indian companies, India-based business, which are listed in the US in the portfolio. So you get the leeway to use that 20% also well. So I am not on the camp that creating alpha in large cap is impossible. It is more difficult, but it is definitely a well-constructed portfolio can create that alpha. Coming to large and mid cap, the universe is bigger, right? So obviously, you have bigger pool of ideas to invest into, and hence I think the debate of creating alpha is much lesser in that particular category.
So I give you 2 things now. One, so there are these minds that say, why do I first put money in Indian large caps? I can rather get a lower cost than do ETF, stick to the benchmark. Second, why do I need to choose Indian large caps when I have access to global large cap companies that are giving 30-35% return in 1 year? So as a fund manager, when you're managing Indian large cap money actively and able to beat the benchmark and able to get that alpha that you're talking about between the same sector and the same industry and choosing the best out of them, what would you tell these sort of minds?
So the first question on active versus passive, I think that's a debate which has been there for a while, not just in India but globally also. And I don't think it has to be either or. I think both can survive. If someone says that I just want to play the category, I don't want to take a fund management call or a AMC call. I don't want to take a bet that somebody can outperform. Happily go to passive. I mean, you'll get the index return, and which is again not bad. Again, in index return is still reasonable. But at the same time, if there is a product brought by a good AMC and with a high conviction portfolio which has been built with a certain philosophy in mind, which has been tuned over years of experience of seeing Indian market and seeing global markets, and if you believe that this portfolio can create alpha, you should actually back that also. So I think it is important for fund managers to be more sharper in this category, and the ones who are able to do it will probably corner a bigger size of the flows. So I don't think it's either or. I think both can particularly survive. When you asked a question about India versus global, that's a very, again, see, globally we have seen mega companies in the US do very well, but that's again a bit funny, because in India we're talking about large cap or small cap, saying why large cap, while what you see in US is actually only the large cap which have done very well. Not even large cap, only the top 7-8 companies which have done very well. So it's a completely different story out there. And those companies are exceptional strong companies. They have excellent innovation. They have very good dominance in some business models, and they play on a global stage, right? They're just not US companies, but they are global companies. They have businesses around the world. So there is a reason why those stocks have done so well. If Indian large caps are going to compete with some of them head on, I don't think that's a I don't think that's a plan. I mean, there's no Nvidia equivalent in India making GPUs, or Microsoft equivalent or Google equivalent here. But we have our own champions for our market, right? We have leading companies which make some of the best cars suited for India. We have leading banks which serve the Indian population. I mean, let's not forget we are at 1.4 billion people population with a per capita of around $2,000. And next 5, 10, 15 years, this $2,000 can easily go to, let's say, $4,000, $5,000. And there are a huge set of companies which have businesses in India which can grow multifold in that opportunity. So I would look for, it's not again US large caps versus India. I think everybody should have some allocation to the world global tech champions. But Indian large companies are playing a different game. I mean, they're playing the game of India becoming much richer country from 5-10 years from now. So definitely there is no breadth of opportunities in India as well.
And we spoke in length about price and value. Do you think that today's valuation is a bubble?
In which one? In US?
Global?
Well, I don't know. It's a very tricky concern. We are sitting
because we have this debate all the time. No? Yeah. Bubble. Yeah. And you've seen multiple cycles, so you would have seen certain bubbles here and there.
Yeah.
Do you think that this phase is a little bit of a bubble?
See, again, with a disclaimer that we are sitting in India far away from what is happening there, so we're clearly not as clued on to that as we are clued on to what's happening in India. But a few points do suggest this. Like we've seen, AI itself, the technology itself may not be a bubble, but maybe AI stocks are pricing in some bit of exuberance. We have seen that, let's say, the 99-2000 internet period, while internet itself, .com itself was, technology has obviously survived and flourished, but a lot of the companies then didn't flourish. A lot of those companies went bust. Similarly, we saw the 07 crisis, the period when a lot of boom happened in the investment banking side, the American banking side, and a lot of some banks did go bust, but eventually things settled down. So few things like what OpenAI is doing in terms of structure, when they are taking stake in different companies taking stake in OpenAI, their customer, investor, that chain does make it a bit scary. So people have seen past cycles. This does have some similarity with what is happening there. People have made a lot of money. It ticks that box. Now it's getting the size, absolute market cap of these companies are huge. Can we make the same amount of return like what we've seen in the last few years? Again, doubt. So I think many signals are there, but I don't know if I can say with conviction that that's a bubble or not, because too many things are happening at this point of time. But as a risk management, as prudence, if you have made money in that sector, I think it makes sense to take some money off.
And some examples of exuberance that you've seen in the past in India?
Plenty, right? Plenty. I mean, the market cycles are always, we've seen more recently defense. The entire narrative on PSU defense, which was very, very strong, which this comes top of my mind 2023, 2024, when PSUs were the raging theme. I've met some of my friends whose parents in their 70s had the portfolio 100% in defense stocks, because that was the in thing at that point of time. And then you see how those things eventually play out. So stocks move up in anticipation of things improving, but if earnings don't catch up or numbers don't catch up, then that's not a very nice place to be in.
And multiple examples now recently, so much coming in the news about how earnings not coming in and then prices actually going down. Do you see that more often happen in the large caps or in mid and smalls? Because people think that, okay, because I'm taking that high risk, I should get high return. But that high risk word is being underplayed across the board.
Yeah. See, large caps generally have companies which have been existing for longer. So you have a much bigger history for large caps. So these kind of things happening in general for large caps, is the chances are less, because how these models go through, the cycles involved in it. Typically what you're talking about will happen in new companies which are coming in, or existing companies going to new businesses, and with the hope of massive growth coming in. So which is usually in the mid and small cap segment. But again, that is a segment. I'm not painting the entire segment in one brush. Like Bajaj Finance was a small cap company 15 years ago. They did a lot of good things, and that small company became a mega company over the next 15 years. So if you have a plan, if you are in a TAM which is big, right, and you execute very well, surely there are multi-baggers there. So I'm not trying to brush the entire thing with saying that it's not possible, but we should be selective, and that's where the research and the fundamental knowledge comes into picture. So
putting all of this in with risk management, how do you determine the size of that particular allocation?
So there are a lot of parameters. So ultimately, if I have to simplify it a position size in a fund is very simply a factor of how much conviction you have in that company, in the business model, and how much upside you think is possible, right? If you have to put it in sort of a 2x2 matrix, conviction and upside, if you have very high conviction and very high upside, which is the top right, should be the highest sort of a position size. But that doesn't happen very often. It is, once in a while you see, very high conviction and massive upside, because these things get captured very quickly. But when it happens, you need to make sure you are there. What is most often is high conviction and reasonable upside, which is probably a second bit, which is where most of the portfolio lies. You have high conviction in these stocks, they have a reasonable upside. Sometimes there is low conviction, but the upside could be huge. These should also be there in the portfolio, but the size should be managed. You don't want to have very big position here, because your conviction is low and you have very big position and it doesn't play out. You have hope of big upside, but if it doesn't play out, the damage to the portfolio could be pretty bad. Some of these ideas should be there. They are your alpha generating options. Lower in conviction because of various reasons. Business model is evolving, TAM is not clear, management quality is still getting formed. You may have low conviction, but if it plays out, the upside could be huge. So you need to have a few of those options as well. What you should absolutely avoid is low conviction, low upside. I think that should be definitely not there. So it's sort of a matrix which we kind of need to have in the mind, and manage upside and risk at the same time.
And how does this evolve to say, okay, I'm buying 3%. Now I say, after seeing everything, after reading, doing your analysis, and say, okay, now I'll increase it to 4 or increase it to 5. How do you determine the increment that you put in?
Same conviction. Conviction is not a static number. You have certain conviction, you do more work on it, You meet the company, you meet the competition, you go and see the factories, you talk to, say, distributors, you spend time looking at various things, and conviction may go up or go down. So when the conviction goes up, again, if you go back to the matrix, conviction goes up and the upside is there, you tend to increase the position size. And there are plenty of examples, right? You have a certain company at 3% weight, you have you do your analysis and you feel that the company is on the right path and you feel more convinced about it. So you tend to increase the exposure to it.
Does price come in at that point? Because what happens suddenly, everybody starts factoring in, price starts going up.
Yeah.
So at that point, do you participate in that price up?
It, again, very case-to-case basis. When so it goes back to what we spoke about, price and value. Typically what happens is, if you have better conviction in your numbers, you go back to the value which you had in mind. To give an let's give an example. You thought a stock is worth 100 rupees, right? And then the current price was 90 rupees. And so you had some position in it. Then over time, you're doing more and more work, and you figure out the stock is not actually worth 100 rupees, it's worth 120 rupees. You have more conviction based on watering. The stock may have moved from 90 to 105, but you still have better upside now than what you had earlier. And although stock has moved up, you may end up buying more. But if the stock has moved from 90 to 130, for example, then you just need to wait it out. So it's, again, very much case specific, and I'm putting a structure to it, but there are a lot of emotions which come on top on each one.
My next thing was I wanted to ask you next, okay, 130, does it come under your, I missed this one?
It is. I mean, fund management has got a lot of emotions involved in it as well. There's no two ways about it. But we try to be, as unbiased as possible. It's not possible to be fully unbiased. But, you try to use it when the stock has gone to 130 and you think 120 is your sort of fair value, even after kind of pushing up your assumptions and all these things. Then the right thing to do is not to buy. Then you sometimes FOMO gets in and people start buying, saying that that's the wrong thing to do.
And then further 200, 300.
I mean, then your 120 was wrong, right? If the stock does go to 200, then your estimate of intrinsic value was wrong. So you have to go back and think what was the mistake you did in estimating the intrinsic value. So again, I'm saying I will not feel very bad if I believe the stock is worth 120, but market takes it 200. I won't feel very bad. What I will feel very bad is if
I get the 120 wrong.
Getting the 120 wrong. If I, have I done enough analysis to say 120 is the right number or 200 is the right number, right? So you can't obviously get, market and you on the same page. But when you have a view and you don't implement it, I think that's the thing which you have to go back.
And how do you manage that biasness to sell? Because you made money, and then there are some phases in which you say, I'm just going to hold it a little bit more, little bit more.
Yeah.
How do you manage that? And how does that process go through? Because you've built a sizable position at that point then.
Yeah.
Even if it's a smaller position and it's done very well, it doubles, it goes to, adds 1 more % to your entire portfolio.
Yeah.
How do you take that decision to?
So usually a sell instance has got 2 or 3 reasons why you sell something. One is, of course, what you mentioned, that if the stock is well above the intrinsic value. I mean, if it's few percentage here and there, because markets are very moody, right? I mean, it could be, if in this example, if 120 is my intrinsic value, if it goes to 130, it's like it can always swing up and down a little bit. So you don't need to act on every of those movements. But if it's well beyond, if it's 120 is my fair value, it goes to 150 or something of that sort, then it is, and for no reason to change my 120. Without a change in the fundamentals, the stock is getting in the exuberant zone. So that is usually one reason to sell. And the second is, at the portfolio level, you may have something else which is looking more interesting. Maybe in this stock, in this example, 130 to 150, there's some bit of rally left. But there's something else which has got a much bigger potential upside. So you have to consider that also. So sometimes the switch is also a very important thing we should think about. Maybe there is some upside left here, but if I start switching from stock A to stock B, the upside is still a lot more. So that's the other reason to sell.
Okay. And is fund management a one-person job?
I think it's definitely a team job. I think, obviously the philosophy of each fund manager is unique, but this market is huge. I mean, you can't operate without a team of research team, with your colleagues. with not just in India, but also one of the things in Franklin, which is very interesting, is we work with the global team. One of the unique things which we have is, our India team is part of the Franklin Global Investment Team. And we have our colleagues in China, in Singapore, in Brazil, in UK, in different parts of the world. And a lot of insights which we learn from them are very critical. I mean, we are a connected world. What India is experiencing now is something maybe China's experienced 10 years ago or 15 years ago, or maybe what US has seen many years ago. So we have to learn from the experience of others who have seen it. And in this connected world, having a connected team is a very, very critical asset. I mean, there's so many stocks which we have invested in. We have spoken to a Chinese analyst who has seen something like that play out. And let's say Meituan in China, how they have managed food delivery and all this kind of thing. Commodities, understand what is happening in, let's say, Brazil or in China. So it is definitely not something which can be done by one person alone. The decisions could be ultimately yours, but the flow has to come from multiple sources. Your internal research team, your team outside, your colleagues in the portfolio management side, you have a sell side who is also actively looking at multiple companies. So it's a lot. That's why professional investment fund management is such a big thing, right?
Comes at a cheaper cost also.
Right.
But looks like a very stressful, very, very stressful job. How do you unwind?
Well, I mean, stress is part of it, and good thing is there's something which we all. It's a challenge we all look up to. I think me and my other colleagues in the industry, we do this because it's something which is a challenge for us and provides us that excitement of going and creating alpha. So something that we opted for, right? It's that we like the challenge the markets offer and the opportunity which we have to create something which is meaningful. So stress is part of it. Over time, you kind of figure out how to deal with it, and it's important to have that ecosystem around you outside of the work as well. So with the family and the support, the extended friends network, all that is extremely helpful. I've got young children, and at least at this age, they are a stress buster. Once they get a bit older, they'll add to the stress, I think. But all of that is quite helpful. I try to play some sport over the weekends. So all that is to the extent possible is a good distraction.
And what are some daily habits or routines that you follow to keep you up and running, at the same time keep you up to date in the market so that you can work hard to generate that alpha?
So in terms of routine, we start a day with our morning meetings, and it's usually a platform for a research team and to share their thoughts of the events which may have happened the previous day or the recent past. And it's a meeting where we have our colleagues from India and Singapore and who are free from other parts also to join in. So it usually lasts for 30 to 45 minutes or so. And after that, what I typically do is I spend the next 1 or 2 hours to clear my emails. To kind of one of the things about this job, we get thousands of emails from research teams across sharing the views. So I think I spend the next couple of hours to look at my emails to see what I've missed, to catch up on some of the updates. If I have any queries to ask some of the team members or outside analysts, I use that time. So that's usually till about 11:30 goes in this. After that is basically how, which is one of the best parts about this job, is how you want to plan the day you can use it. And I typically tend to set up some calls with some companies or with analysts, and a lot of time needs to be spent on reading. I think this job requires a lot of reading. So reading annual reports, reading conference call transcripts, reading what's happening in other countries, other markets. So a lot of time goes in reading. So if you come to our office, which I think you have, I think it's a very quiet place.
Place, very,
I think
very quiet.
It is designed for that. For us to have the time.
I was shocked when I came in. Where's the noise?
I worked in more noisier places than this in the past. It's very quiet. That you have your time to sit and read. And of course, we're all pretty much in the same floor. So you want to speak to your colleague, you can just walk up and speak. But a lot of time does go in just reading and processing what your thoughts. And we don't need to act on everything, right? You just need to figure out when you need to act and when you don't have to.
Let's talk about what we need to act on now.
Okay.
Where do you see opportunities in the Indian market?
Okay, let me take a step back, and I think if you not just now but in general, my bigger view is that India, we spoke about it a few months ago, at the current per capita GDP level of around 2,000 to 2,200 in that range, over the next 10-15 years or so, if it's going to double or triple or thing, which we have seen many countries go down that path. We have the ingredients to go down that path. So if we are going to go down that path, the sectors which traditionally or which will benefit disproportionately will be ones which play on people getting richer, on our aspirations getting better. It can be very consumer discretionary sectors. It can be financial services where people need better insurance products or mutual funds or loans. It can be financial services. It can be in the consumer discretionary. It can be automobiles, four-wheelers. It can be retail, organized retail. People want better clothes, better travel. You want so many digital ecosystem. You want to order food through apps or something like that. So all of that would be a big beneficiary. Healthcare, as people get better off, they want better quality healthcare, better quality medicines. So Indian story is basically, in my opinion, about these sectors which are going to benefit disproportionately over the next 10-15 years. Consumer discretionary, financial services, healthcare, and these kind of and typically these would be the core of my thesis. Generally, commodities or energy and metals, those kind of things have so many moving parts. There will be cycles in that. If you get that cycle time right, you have a chance to make money. But that depends on what's happening in China, what's happening in other parts of the world, and that's a different story. So I would think if somebody wants to take a 5-10 year view in India, the sectors which I mentioned are the ones which are best placed. And there are plenty of good companies here. The TAM is huge. Opportunity is huge. So good company, good management, it ticks all the boxes you would look for.
If you were to give our M2W listeners 3 pieces of advice to go through market cycles and to attain financial independence, what would that be?
3 pieces of advice. I'll just make it one holistic one. Don't put all your eggs in the same basket, but don't carry too many baskets either. Diversification is important. It provides you that cushion if something goes wrong, but over diversification won't help you create wealth. You need to get the balance. I've seen people who have 100% of money in small caps and they had a great time, or forget small cap, it could be more thematic in terms of one defense sector or something like that, sub theme which have all their money into that one particular thing. So that does very well for some time and has got its own risk also. At the same time, I've met people who have got some 60, 70, 80 different products with some small allocation, 2% in this fund, 1% in that fund. You diversify too much, you're not going to be able to create a lot of wealth. You concentrate too much, that has got its own risk. So I think coming to the simple advice is that find the balance. Don't put all your eggs in the same basket, but don't carry too many baskets either.
Thank you so much for your time. I had a wonderful time having this conversation with you. I wish you all the best, but I hope to see you soon.
Absolutely, Harshil. Absolute pleasure doing this. Thank you for inviting me. Look forward to the next one as well.
Thank you.
Thank you.